Markets rallied around the world in July as optimism grew that the Fed's tightening cycle may be over, and with it, a much-debated U.S. recession. Despite growing market optimism about a potential pivot in Fed tightening, we don't expect either the U.S. Federal Reserve or the European Central Bank to pause their rate hiking cycles in the months ahead until an actual and sustained turn in inflationary pressure is evident. As we noted last month, this focus on inflation, a historically lagging indicator, may actually risk a deeper downturn in both the labor market and the manufacturing sector than the markets currently expect. Indeed, while market-implied probabilities of recession have been rising, they still sit short of the levels seen even in the economic shocks that were recession-free in 1998 and 2015. Even should markets be correct and the Fed be set to implement its last rate hike in December, historically, treasuries and credit have provided the better risk-adjusted return in the run-up to the end of rate hikes since 1973. Equities, in contrast, have delivered a more mixed picture in an anticipation to the end of Fed rate hikes. While U.S. equity investors have earned almost 6% returns going into the final hikes, they had to weather drawdowns averaging 5% during those rallies. Having added longer duration treasury positions in June, credit markets have already begun to unprice the prospect of a more meaningful default cycle, with spreads declining sharply in July. As a result, rather than stepping into credit, we continue to focus on our fixed income alternative hedge funds to drive returns, while shielding against the rising credit volatility that typically comes at this stage of the economic cycle. Indeed, hedge funds feature meaningfully within our portfolios, with CTAs and global macro strategies well positioned as fixed income and equity alternatives as markets begin to recognize the recession unfolding in several economies around the world in the months ahead. For more details on how we're positioning amidst rising recession fears, please visit us on ubp.com.